Good afternoon, everyone. Hope you're doing well. Hope you're enjoying your weekend. Let's have a look at some of the key markets, the charts, the trends, starting, of course, with the US market, the S&P 500, which made an all-time record high through the week. And as per my previous videos, I continue to think this market is very expensive. This video is not providing investment advice, but for my clients and I, we're not chasing growth. We're in covered call funds, high income funds, because we believe the market is quite expensive. We still want to be in the market, but we're chasing more income than growth. And we can see the US market had that low in early August last year, and it's been in quite a strong uptrend. And I would draw the line here. So you touch the low there, and up there. And we can see it was a little bit of a rising wedge pattern. It was squeezing. And as the price was making higher highs, the momentum indicators, the MACD and RSI making lower highs, that's a sign that the uptrend is losing momentum or that it's a little bit extended. And you can see the fresh high this week is definitely negatively diverging on the momentum indicators. What I would say is this is the uptrend. So you've got the support or the floor of the uptrend, this rising line, and you can see around Christmas time it broke down. It showed a little bit of a bullish sort of flagging pattern in the short term and broke out of that. This is all pretty textbook sort of price behavior, and quite often what you get is a return to the scene of the crime. So you can see the price rallied, and now the previous floor, it's hitting a roof there. Now maybe it'll trade a bit higher for a few days, but I would say the most likely outcome is that it's going to grind sideways, possibly a bit lower from here. So I would not want to be too heavily invested in the US market going up from here. Looks very overpriced. And if we move across to the NASDAQ, the technology index, we'll see a very similar thing. The low in August, the same. We've got the touch there, the touch there. You can see a more clearly defined uptrend. So we want to touch as many of the key lows as possible when we're defining a trend. And you can see there's one touch there, two, and then lots of grinding along that line. And that is where I would draw the uptrend line. Now you might say it's a little bit of a wedge, and I would actually draw the line there, and I would say that this was a little bit of a short-term blow off top, that it was a false breakout, and then as with the regular market, the S&P 500, we got this bullish sort of flagging pattern and a little pop out the top, and same deal again, you've got that uptrend line and then returning to the scene of the crime. Similar sort of thing here on the, it's not quite the same on the the momentum indicators. There is some negative divergence, but the price didn't technically make a high. So that NASDAQ has been in a, I mean, it's getting quite ridiculous how expensive these stocks are. I'm not calling for a crash. I'm just saying they're expensive. And for my clients and I, we have low allocation and we're not chasing growth. We're not being aggressive. We're more looking at income. One thing that was very interesting this week was the US dollar index, which is a very key thing to watch. You can see the US dollar bottomed in September last year, and it was in quite the uptrend. And that's where I would draw the line. And you could say there was a bit of a rising wedge. And if you recall my previous videos, I was talking about how the US dollar uptrend was looking a bit extended, that not calling it for it to crash, but just saying the uptrend was extended, and we've seen confirmation of that this week. You can see negative divergence on the momentum indicators as the price was making higher highs, which is bearish. It's a sell signal. Rising wedge pattern, that's bearish. That's a sell signal. And you can see it broke down this week with quite a big red candle there. And clearly the uptrend is end. Now, this doesn't mean the US dollar is going to crash. It's just a sign that the uptrend momentum is coming to an end. And what was kind of encouraging is you got that previous high there. You can see that's a pretty key level of support. And I don't know if I want to call that a break just yet, but you can see that was the previous high there, some bouncing there, and then after this uptrend broke, you can see big red candle, a little bit of consolidation around that level, and then Friday night trading for our time, or Friday in American time trading, red candle, and it's maybe still holding that level. I wouldn't call that little move a break just yet, but the US dollar is looking more bearish. It's looking like the uptrend has lost momentum. And for my clients and I, we have quite a big allocation to bonds, and bond prices have been moving opposite to the US dollar. So as the US dollar has been going up, bond prices have been coming down. So we want to see the US dollar break down in, well, there's lots of reasons. There's economic reasons as well, implications for the global economy, but we'll just focus on the charts and the trends here. And we'll look at bond yields a little bit later in the video, just so we can see this this inverse correlation. But that's US dollar breaking down is a positive sign for our strategy. Let's have a look at the Australian market. Not making new all-time highs. The all-time high was on the 4th of December or 5th of December. Now, Aussie market was in, see, you might be tempted to draw an uptrend there, and you could, but then you're ignoring all these lows here. So I would say the trend is more like that, because when we draw it that way, we can see we capture this uptrend and then it breaks down. Notice how that was the previous floor, and once you break it, it becomes the ceiling. Lots of touching there, lots of touching. Breakdown again, and then you might say, well, we're sort of having a channel like that. Now, while the market's going up, that generally is a pretty bearish sort of channel. You know, you've got it's like an upside down flagpole and flag. And the other thing too that concerns me, although I showed this in a previous video, and it's not as likely now because we've made we're making new highs in the short term, but I did suggest that the Aussie market is potentially setting up a head and shoulders pattern, which you could draw. I mean, you could basically draw it like that, and you could say, okay, well, it's a little bit of a complex pattern, but you could say this is the right shoulder. Now, if the market does go on to break that high, then it's most likely that pattern has failed. But I would still say that this head and shoulders pattern is potentially in play, and I would just be a little bit cautious too. Like, even if the market does drift a bit higher, you'll probably see some negative divergence, although I wouldn't say that's as strong as the signals we're seeing on the US market. But Aussie market just probably, again, looking a little bit expensive. Again, for my clients and I, we're in the high income funds, we're exercising caution. We do have some specific ETFs, such as in mining, because mining is very underpriced relative to the rest of the market. But just a little bit of caution there on the Aussie market. It is holding that support line, that sort of 8,000, or really 8,100 seems to be a pretty key level. I would probably be an accumulator down here. But up at these levels, I'm very cautious. Let's go across to gold. Gold is looking a lot better. The chart is a little bit messy, but we can see gold made its all-time high on the 30th of October. Since then, it had a bit of a sell-off, a bit of sideways price action, but what it's done to close the week is it's made a higher high. So it hasn't made an all-time high. We're looking at the US dollar price here. It hasn't made an all-time high, but you can see it did exceed the previous high. So that's a bullish sign. That's a good sign. And these patterns are a little messy here, so I don't quite know how to draw this, but I've seen some chartists that I'm following online are drawing like sort of a triangle pattern there and saying, well, we've broken out, we've passed that high. You know, you could say this was somewhat of a flagpole and a flag maybe, and you know, it's breaking out of the flag. I'm not super confident in that draw. Little bit of indecision with the gold price. It's going to struggle to make a new all-time high, I would say. Nearly got there last night, got within about $10 or so. I'm leaning towards the price looking positive, but again, for my clients and I, we don't have our full allocation. I generally recommend a 10 to 20% allocation to precious metals, but of course, when gold is at an all-time record high, for most clients, I've reduced that to 10%. And it's not because I'm bearish on gold or I think it's going to crash. I just don't want to be full allocation when something's at an all-time high. But you can see the price of gold that's the all-time high, and it's barely, I mean, maybe it's 1% or less below its all-time high. And this will show, and if you're a client and you're watching this, you may note that I don't always recommend that you buy gold mining stocks, and I usually sell the gold mining stocks first and keep your physical metals. And that's because the gold mining stocks are very risky and they've been just underperforming and disappointing for really over a decade now. And if we have a look at GDX, which is the global gold miners, you can see from the highs in October. So gold's only down 1%. The miners are 14% below their and that's not an all-time high price. That's just the recent high. Now they have recovered a bit with the price of gold, and you might say, that they've broken out a little bit there too. That there's somewhat of a falling wedge pattern. You can see at the bottom there, you've got some positive divergence on the momentum indicators. So, for those who can take some risk and can trade gold miners, you can see that was probably an entry point. And had you bought, even if you just bought the previous low, like let's say if you didn't, let's go back and let's pretend you didn't know the future, and you're looking at the price there, and you're going, okay, well, there's positive at the previous low. You got that red candle there. You could see there would be positive divergence on the momentum indicators. You'd be buying at let me just draw that in. You'd be buying at the previous low after, from October 22 to, December, so say 3 months, you had, well, basically a 20% correction. So let's say if you bought in there, you bought in at the previous low after a 20% sell-off. It went a little bit lower, but right now you're up 7% in the space of 4 or 5 weeks. So you're doing okay there. But I'm not super confident in that draw either. The chart's a little bit messy, and I wouldn't be, I don't like to buy gold mining stocks when the price of gold is at or this close to an all-time record high. That's I don't think that's an appropriate risk reward investment. So let's have a look at the price of silver. So again, with silver, you could say it's been in, so after the peak in October, it's been in a downtrend. You got a touch there. Now it looks like it's attempting to break out from this pattern. And you could draw the low there. So it looks like a little bit of a falling wedge pattern on the price of silver. And similar sort of thing, momentum indicators, maybe there's a little bit of there's a low there and a slightly lower low, a little bit on the RSI there as well. Again, not super strong signals, but had you followed these momentum indicators and the falling wedge pattern, buying at a support level, that sort of $30 level is a pretty key psychological price barrier, and I would say that's going to function as a bit of a support level. So to see it trade below, so 30 is about there, you can see how key that $30 level is. So you probably want to be buying down here. So when it dipped below the 30, so you had the dip below the psychological price barrier of $30. You had the support line there that you could buy, the previous low you could buy. You had some positive divergence on the momentum indicators. And had you bought around, let's say you didn't get the low, you just bought at the previous low, so you bought around there at say 29.50. The price has moved up 5% in a few weeks, so that's not too bad. And it looks like, you can see from this chart, it is trying to break out. It's consolidating above the previous resistance level. That is somewhat bullish, but let's not get too excited yet. It's attempting a breakout, but it's not quite there. Bitcoin, not a whole lot to, I don't know that I have a whole lot to say about this chart, other than, again, you've got this sort of this $100,000 level is going to be a pretty key psychological price barrier. It's wrestling with that level at the moment. As you can see, a lot of compressed trading activity around that level. You could say that the price, so Bitcoin actually did hit a new all-time, you can only see it on the spikes on the daily chart, but it did actually hit a new all-time high. But note, it's hitting that level, but look at what's happening to the momentum indicators. Negative divergence on the momentum indicators. And maybe let's be a little bit fair to Bitcoin, and let's zoom in and do a shorter term time frame chart. So let's do maybe a 4-hour chart. And let's just clear that a little bit. See, that looks a bit messy. I don't quite know what to make of that. But you could say, the price made the higher high there. That was the all-time high, and the momentum indicators starting to negatively diverge there. So that was, all-time high, negative divergence. It's had a great run. That was the run from 13th of January. You're talking about a 20% move or so in the space of 6 days. You should probably, and with any asset, you should probably take a little bit off the table when you see a move like that. I don't know what to make of this pattern. This is people will try and draw things and say, oh, it's a diamond pattern, or something like that. I find that to be a little bit of nonsense. So I don't have a clear answer on Bitcoin's direction from here, other than to say that it seems very overpriced in the short term. there's been, Trump promised a strategic Bitcoin reserve and he signed all those executive orders. There was no mention of Bitcoin, nothing done about Bitcoin. So I'm going to say on Bitcoin right now, I don't know. No clear direction on the chart. We need to see some further action. And bonds, bond prices. So this is 20 and 30-year US government bonds. As we talked about earlier, US dollar has been going up. So because the US dollar has been going up, bond prices have been coming down. And we've seen a very significant sell-off from the 16th of September high in long-term US government bonds to 10, 12 days ago, 16% decline in price. You can see as the price is trending down, the momentum indicators are flattening. So they're showing positive divergence. That's generally a buy signal. Bond prices have been very weak for a long time. There's not a whole lot of trend action there. You can't really draw something there. All I would say is that, price making lower lows, momentum indicators diverging, making higher lows. So just bear with me for a sec. The computer is glitching slightly. Okay, there we go. I would say bond prices are, and if we go to a 5-year chart, this is where bond prices are at from the 2020 highs, down 50%, historic crash in long-term US government bond prices. And this is a major, major low here from October 2023. So for me, this is a asset class that is fundamentally very underpriced. It doesn't mean it can't go lower. It doesn't mean it can't crash from here. But for my clients and I, again, I don't know if this is appropriate for you, but for my clients and I, we have a 10 to 15% allocation to US government bonds at the moment. So underpriced market. And the Australian dollar, I talked about the Aussie dollar looking like the sell-off was overdone. You can see the Aussie dollar peaked in September around the same time the US dollar started its run. And you can see it's been in this pretty sharp downtrend. Now, I would draw it there because, see, if I just touch the top of those candles, note I'm not including all this grinding action here. So I would draw it like this. And I would say that that was just a little bit of a false breakout attempt. It's in this really tight channel. Those kind of channels don't last forever. And you can see just at the bottom there was a little bit of a broadening, falling wedge pattern. I guess you'd call that a wedge, sort of a little pattern like that, because that green candle there, that big green candle, that was the break move, I would say. And you can see as that was happening, there was just starting to be a little bit of positive divergence forming on the momentum indicators. But I would say now the Aussie dollar has broken out from this downtrend. Doesn't mean it can't return to the scene of the crime, that it might go like this and just grind sideways a bit. But I would say the downtrend is looking like it's done. And the question is an uptrend starting? I don't know. Now, I've left some I'm about to show you the oil price, and I've left some of my my drawings on there because it's quite a complicated chart. So this is how I see the oil price at the moment. So this was the high in April last year. I think that was a false breakout. I've drawn the line there so we can capture those highs. And you can see when it broke out from that downtrend, there was tight consolidation there. And we've got this key $72 level, which was a low there, and then it functioned as resistance there for quite from September through December. Lots of hitting resistance and selling off. You can see it was in a very tight range there. So that's why I've drawn the line there, and I've called that a false breakout. Because if you try and capture that high, you draw it across there and then you're missing all this action here. So I would say that's where the line goes on, well, my chart, my interpretation. And I think to start the year, remember Trump said, and this is like, I don't know why people believe politicians or have, have faith in politicians. Trump said he's going to, drill baby drill. He's going to bring the price of oil down. Well, what's happened since his election? I mean, when was it the late November, the voting? So here's late November, the price. Have a look at what the price of oil's done. Even if we take the midpoint of that trading range, because it was in that trading range from September to November, around the time Trump was elected, the oil price went up 15% and it's still up 6.5%. So this whole Trump's going to drill baby drill. Well, why is the oil price going up if he's going to drill more oil? You could say it was being priced in prior to his election. But I think the oil price has broken out. and it's doing what you'd expect. Notice how it made a higher high, so it got above that October high of around 77. It touched 80, pretty key psychological price level. Having a bit of a sell-off now, but I think it's going to find support at these levels and either grind sideways or trend higher from there. And we'll just have a really quick look at bond yields, so interest rates on 10, 20, and 30-year US government and Australian government bonds. Keeping in mind, if the interest rate or yield is going up, the bond price is coming down. We looked at that earlier. And you can see this pretty key level at 4.7% on the 10-year US government bond. It did briefly break that level, but is now selling off. And you can see after a big uptrend, and I would say the uptrend is still intact there, and it hasn't broken this, you've got that level there, which is pretty key, that sort of 4.5% level. We might move that up a bit higher, and you can say, that's the high. You can see it back here as well. It's bouncing from there, it's bouncing. So it hasn't broken yet, but you can see that there is, as the price was making, or the interest rate was making higher highs, negative divergence on the momentum indicators. They're not making new highs, they're diverging. So that was a sell signal. You might even be able to draw a little squeeze there and say, some traders might draw it like that, or they might draw a wedge there like that and say, okay, it's popped out of that rising wedge, it's breaking down. Still a bit too early to call the top here. It could still, rally back up and test the 5% level, but you can see the uptrend is starting to lose momentum. And if we look at, for some reason, no one seems too interested in the 20-year yield, but if we go to the 30-year yield, which is the longest time frame, a case could be made that it's broken out. So you've got that high in April, and you can see it broke out, it returned to test, because that's a pretty key high, returned to test it, and you might say, someone could make a case and say, well, it's breaking out and it's going higher. Sort of negative divergence on the momentum indicators. I would say that's still valid. It's still showing on the RSI. So as the price making higher highs, momentum indicators not making higher highs. Excuse me, again, that's a sell signal. Still a bit early days on this one, so I'm not going to. The US dollar breaking down is positive. TLT at a key low is positive. The yield charts, it's probably a bit too early to say that they're breaking down yet. Maybe we're going to see just some sideways action for a while. But I maintain that for my clients and I, 10 to 15% allocation to US government debt, and up to, but not trying not to exceed, a 40% total allocation to bonds, splitting it between emerging market bonds, which pay 7 to 8% running yield, and having some Aussie bonds, because we are Australian investors. It's easier for us to, I guess, just to diversify as well. The Australian yields are looking a little bit better. So keep in mind, you want yields to go down for bond prices to go up. And you can see the Australian one, it's holding that top from November. So this is the 10-year interest rate on Australian government bonds. A little bit of an uptrend there, breaking. You could say this was a bit of a channel, bit of a squeeze, hit the high. Again, you can see as it was hitting the same high, it might be a little hard to see on the video, but there are candle wicks there. So that's the same high. Negative divergence on the momentum indicators, breaking down from that little short-term trend, and we'll see something sort of similar on the 30-year. It did make a fresh high, but again, the momentum indicators negatively diverging, indicating that it's a sell, which means bonds would be a buy for investors who are, it's assuming it's appropriate for you as an investor to have government bonds. I don't know if it is. Reach out for a private chat if you'd like to find out. But they look like they're topping again, and that's sort of that 5% level, which is there. That's going to be pretty key for the 30-year Australian government bond, especially with, the market is not expecting the Reserve Bank of Australia to raise interest rates at all. There is a lot of political pressure in Australia to bring down interest rates because people are really struggling to pay their mortgages. Australians have an insane amount of real estate debt, especially at the investor level. So it seems like these yields are topping and bond prices are bottoming. And that's probably a good place to finish things up for today. Thank you for taking the time to watch, to listen. I hope it was informative, and look forward to showing you the charts again soon. Have a great weekend. Cheers.